Where does one see returns in, 3 to 5 years?
Yeah, so I think if your view is that we are in a sustained period of higher inflation and low growth, which is the definition of stagflation,
Hmm.
then I think what you want to be investing in is very different from if your view is that inflation is relatively transitory, and maybe that's measured in 1 to 2 years, and growth will slow, but it won't be a hard contraction in the economy. To answer your question, if we are in that former scenario, that first scenario of stagflation, basically what you want to be investing in is assets that are benefiting from that inflation. So that could be commodities related. It could be in the form of investments that generate cash flows that are linked to inflation. So that could be thinking about real estate. A lot of real estate investments have rental escalations that are linked to inflation. So
Right.
that's helpful. And in a low growth environment, in a high inflation environment, those dividend yields or those income yields from property should be sought after by investors. The other thing that we talk about a lot is we're trying to make investments that are all weather. That is, they can perform well, whether it's in a stagflation environment, whether it's in a low growth, low inflation environment, or whether it's in a high growth, low inflation environment, which is what we've had for the last 10 years. And those types of companies are companies that have pricing power, that can lift prices if there is inflation, that are capital light, they don't require a lot of physical capital to grow, and so on. So a lot of the big technology companies we refer to as having those sort of characteristics where they can raise prices, whereby they're creating these markets, whether it's in cloud computing or within software as a service. Those markets are actually growing rapidly, and they're creating these new markets that businesses and consumers are adopting because it lowers their cost of doing business. It's a cheaper form of entertainment for them, etc. So, we do think a lot about macro, but at the end of the day, it doesn't overrule our sort of bottom-up fundamental investing philosophy.
Got it. So if we have a company that is able to pass on higher prices to the consumer, which therefore protects their margins, but how would that work if it was in an environment when there's low economic growth, rates are high, therefore people are sort of curtailing their discretionary spending? So isn't there a bit of a balance between raising prices but not raising it too much, which therefore stifles demand?
Yeah, exactly. I think the other thing you've got to think about is from a consumer's perspective, of which we're all consumers by definition. If we think about, streaming services as a form of entertainment, if we have 3 or 4 streaming services and we go through an economic downturn and we're looking to reduce our costs, well, maybe we'll reduce one of those streaming services. We won't have 3 or 4, we might have 1 or 2. So you're right, there is risk in that particular category of consumers saying, you know what, we're gonna switch off, or we're gonna trade down. So there's definitely risk in certain categories like that. But I would also sort of juxtapose that with the fact that it's pretty good value to have these streaming services. You might be paying $15 a month for a huge content library, as opposed to, let's say, if you go out to a movie, you're paying $15 a ticket or $20 a ticket for an hour or 2 hours of entertainment. So I think you're more likely in a downturn to see people, and this has historically happened as well, people actually substitute expensive forms of entertainment for low cost forms of entertainment, which streaming is a low cost form of streaming entertainment.
Good point. Good point.
Another example might be, I guess, before the current environment that we're in now, our view was that consumers would be substituting goods purchases, which they made during COVID, because they were locked down and they were at home and they were going to Bunnings, they were upgrading their homes, they were upgrading their appliances, and so on, for services. The economy opens up, you can travel, you can go to coffee shops, restaurants. So you then reduce your goods consumption and you increase your services consumption. In the world that we now find ourselves in, where yes, things are easier to do, you can go to restaurants, you can travel, but you know what, maybe given the slowdown, given the fact that interest rates are going to start rising in the next couple of years, maybe we won't go on that big overseas holiday. Maybe we'll just travel domestically. And so that's, again, another form of substitution that households can make to manage that low growth, slow economic growth environment.
Interesting. So in a way, you could sort of say that consumers will still spend, but instead of going on that very expensive holiday overseas, they substitute with something locally. So if you're a sector or an industry that caters to local tourism, for example, that could be part of the portfolio which can weather all seasons. And that's very much a bottoms up approach to investing, because you're pretty much thinking long term, aren't you?
Yeah, we're thinking 5 to 10 years. In a lot of the sectors in financial markets, it's hard to invest in companies that you can have confidence in for a 5 or 10 year period. It tends to be a pretty short list of companies. So, you know, the themes that we've touched on in terms of travel, you know, we haven't really got investments focusing on that sector because a lot of the companies there just don't meet our minimum quality criteria in terms of sustainable competitive advantage that can do well in both a boom and a bust type of economic environment. There are some examples domestically of travel-related companies like Webjet, for example, where it's a platform business that is actually a pretty reasonable business. It's a little bit small for us. We tend not to invest in companies of that size, but it's probably one business that we could invest in theory, but we don't, just based on the fact that we can fish in a global share market where the opportunity set is so large and so high quality that we tend to invest in technology platforms in overseas markets.
But if a company like Webjet, for example, or something locally who's smaller, who might go under your remit, wouldn't that still be quite an attractive proposition if the fundamentals stacked up?
It would. We tend to outsource our smaller cap investment to fund managers, and we'll prioritise our direct investment research in the larger set that is there, like the one I described, in terms of offshore direct investments. But certainly we'll use local fund managers that have the capability and capacity to go and dig through the weeds and look at hundreds of companies in any given year and make those allocation decisions. So there's certainly those managers out there that we try and leverage.
Got it. But for yourself and your team, you're very much focused on those quality overseas technologies companies. Is that correct?
Yeah, we really focus on a few sectors. Technology is one of them. Healthcare is another. Consumer to a lesser extent, because it does still tend to be quite cyclical. Industrials is a little bit cyclical as well. But there are companies in the industrial space that are actually set to benefit from some pretty strong long-term trends, being deglobalization, which was something that really started under President Trump,
Mm.
where he was sort of bringing manufacturing closer to the US or within the US, away from China. So that was a thing that was started really gaining traction under Trump. But then it gained even more traction as we went through COVID-19, where it was pretty obvious that um, supply chains were not very resilient. There wasn't a lot of redundancy in supply chains, which meant that over the course of the next few years and probably the next decade, countries and companies all around the world are going to have to add redundancy. They're going to have to invest in more capacity so that there is that buffer that was not in place prior to COVID. We've gone from a just-in-time system to a just-in-case system. So there are a lot of companies, or there are a few companies that we've invested in that are expected to benefit from both that increased capacity in supply chains. And the other point, which I haven't touched on, is automation. Companies are looking to become more efficient, deliver product to their customers in a lower cost and more efficient manner to protect their margins. And that's becoming even more important now with inflation.
But that ability to invest in, expanding the coverage of supply chains, that's very much for the big boys, isn't it? Like, it's very hard for the smaller guy to sort of compete, because I know recently Apple decided to perhaps create new supplies in Southeast Asia. Now, I can understand how an Apple could do that, but for the everyday mid-tier organization, expanding their supply chains and bring it locally, for example, that's going to be quite a substantial investment.
Yeah, no, it definitely is. And it's something that I hope we see more support from in terms of government support. We have seen signs of that from both sides of politics here in Australia. So I think that has to continue. Our manufacturing sector here in Australia is pretty much non-existent these days, as compared to when 20 or 30 years ago, when we had an auto sector, and now we don't. And there are a lot of other industries like that have now gone. But I think the types of products that will be manufacturing will need to be higher end products. In general, I think there will be exceptions. For example, in commodities, we produce the world's best iron ore. We produce some of the best lithium in the world, which goes into batteries, which obviously are in huge demand, and the demand for lithium is expected to increase by a factor of 10 over the next decade. And we have some of the world's best lithium mines in WA. But back on the point about manufacturing, companies over in WA are looking to not only dig up lithium out of the ground and send it offshore to be converted into chemical product, which then is further refined into batteries. But so what we're doing here in Australia is looking to increase the value add from just mining the stuff to actually creating chemical. So that's taking one step up the value chain. And I think we're going to need to do more and more of that going forward. And I noted that Labor have a $200 million battery manufacturing grant in their budget, and a $100 million battery incentive, which is more broadly than just WA. So I hope to see more of those types of initiatives.
So it's very much vertical integration, but keeping it in your backyard, essentially.
Yeah, exactly. So rather than giving the margin to companies in Korea or China, we'll be keeping the margin here in Australia, and that will require investment up front, but the payoff will come.
It will also require changes perhaps in immigration law to bring in skilled labor, because it's very much immigration, education in terms of the next generation, So it's not an easy decision to make, isn't it? Hence, you're saying this could take at least 5, 10 years to see this whole new deglobalization theme roll out. Hey,
Yeah, exactly. And I mean, the deglobalization is one part of it. This sort of sustainability revolution is another. Regardless of your views on climate change, the investment that's going into those sectors is real, and the opportunity is real. So, um, you know, having the will is one thing, having the funding is another, having the expertise and capabilities and labour pool is another. Um, and I think training is a big piece of the puzzle. Training and upskilling and retraining the workforce. I think that's going to be a much bigger part of everyday life going forward, as opposed to once upon a time you go to university, you get your degree, and that's it. Now I think people are changing jobs, potentially changing careers, 5 or 6 times throughout their working life, and that requires retraining. So that's a big piece of the puzzle as well. And you touched on immigration, which we haven't had for the last 2 years, and that's going to be a big driver to support those initiatives.